Hello and welcome to AJ Bell's latest Off the Road webinar. My name is Paradiuk and I'm the Business Development Manager for the South East North region. And I will be your host for the next 90 minutes. The content from today's session is that which we recently delivered around the country across 8 cities. It was great to be back out on the road, delivering our talks in person. And whilst hundreds of advisors made that trip to see us, we are aware that this online content works well for those that are still unable to make the in-person events. You can ask questions throughout the session via the chat function. Our team will ensure that questions reach the relevant speakers and we'll come back to you as quickly as we can. You can also put any questions or comments on the feedback page that will pop up immediately after the webinar finishes. So please ensure you've a drink in hand, sit back, relax, and enjoy the variety of talks we have in store for you today. I will start by providing a business and platform market update. For those that don't know us, I thought it'd be good to give a brief background on who AJ Bell Invest Centre are. So we have offices based in Manchester and London, our operations operating from Manchester, and our media and PR teams operating from London. We now have over 1,000 staff, and we're the 4th largest platform in the market space as well. The next point is important. We've undergone the headache of re-platforming. We did that back in January 2014. I know that's something key which advisors look for when doing due diligence on new platforms. We IPO'd back in December 2018, but it's also worth mentioning that we are privately owned still by key directors. Andy Bell, Fergus Lyons mentioned that. That's again key when advisors are doing due diligence on platforms. With a lot of private equity coming into the market, it's good to know our ownership structure. Finalytic and independent publications like Platform and Landcap, we always get good reviews from them. If you want access to those reports, we can give them to you. And we also have a commitment to meet 150% of our regulatory capital. Any accounts and financial information can be found on our holding group website, ajbell.co.uk. Next, we'll move on to price and where we fit into the market space. Our standard charging tariff is up in front of you now. We're 20 basis points to $1 million. That then tiers to 15 basis points between 1 million and 1.5 million. Tiering again to 10 basis points up to £2 million, and then 0 above the 2 million threshold. There is a small charge which is applicable after £10 million, and that's 2.5 basis points. The one exception to the charging structure, which I've just gone through, is on the pension side. The pension, as we are as a true pension, a true SIPP, should I say, you can get access through to commercial property, DFMs, trustee investment plans, so it had some fixed fees associated with it. In combat to that, looking at our segmentation, we brought out a new account called the Retirement Investment Account, which is aimed at the low end of the market space. So this starts at 0.25, but encompasses an all-in pricing structure. So there are no charges for account setup, transfer in, drawdown, dealing, etc., etc. And that's really opened us up to the lower end of the market space. Looking at a piece of work which the Landcap have recently done, I'll just highlight that for you so you can see it a little bit better. You can see our different pricing structures on the screen right now. Now this assumes a mixed wrapper, so it's a drawdown pension which makes up 50% of the portfolio and a 25% ISA and GIA as well. As you can see on our old tariff, once we got past the 200k mark, we were super competitive with the market space. Now, whatever your client size or requirements, you can have a cost-effective plan with us. The RIA has opened us up completely across the board. So if it's a low-value case, it's competitive. If it's a high-value case, it is also competitive as well. Looking at price as well, I just wanted to take a closer look at how important this is for the client journey. This case assumes a 500k account, and it charges at different pricing points, at different basis points, and looks across a 30-year journey as well. If we bring in the differences on there, if we look at the 5-year mark, on the 16 basis point difference, the clients can save £5,000 after 5 years, which is a huge amount. And looking at that across a 30-year mark as well, £90,000 just above that comes out. So pricing is really, really important when you're doing due diligence on platforms. Whilst we are competitively priced, we're also a profitable company as well, and a successful company. We take a look at our interim results here. Customer numbers up 17%, AUA up 15%, revenue up 21%, and profit before tax up 39% as well, making sure we're a stable company and we can still continue to output at those costs which I mentioned before. We take a look at that a little bit further. We look at a 6-7 year time frame. Retail customer numbers and assets under administration, there has been consistent organic growth there as well. From dealing with advisors like yourselves, we aren't in the space to acquire books of business. There is a small exception to that, which I will touch on at the end, but it was a technology acquisition rather than a client. And again, looking at financial strength, we come out at the top of the independent platforms. If we take away some of the outliers, Standard Life and Aviva, which are insurance companies, ourselves at the top with the likes of Transact there as well. Moving on, I mentioned before about the profitability and the ownership structure of companies. From being on the road with advisors, it has been increasingly apparent to ourselves that ownership is becoming a greater consideration when they're looking at platforms. Some of the different scenarios on the screen you will be very familiar with. Anacap, private equity, have come into the market, acquired Novia and Wealthtime. We've seen James Hay acquire Nucleus because of the sellout of Sanlam there as well. With these changes, it always brings uncertainty to client banks and to advisors as well. There's the possibility of replatforming on the cards with private equity creeping in. There's also the concern whether charges will be brought down or whether they will remain the same as well. Looking at our advisor adoption, there's a couple of quotes here which we'll run through. An advisor mentioned, we're great for clients coming up to drawdown. That's something else we've been accoladed with this year from Money Marketing Awards and the Schroders Awards as well. Also gave us great write-ups, and we won awards for drawdown proposition. General finding in the report, so AJ Bell Invest Centre was the only platform to increase on its satisfaction levels over the past year. We take a look at this a little bit further, and we're top 4, coming out at 4th. We tend to tussle and change on this leaderboard with the 4 which are in the top there. One thing to point out, which we mentioned when we were on the road, is the BDM support. We're the highest for the BDM support. We've got a great structure in place now to be able to cater for all of the needs of our advisors and back office staff that we deal with at firms as well. What's really pleasing to see as well is advisors who are using us aren't just using us as a secondary or tertiary platform, they're using us as their primary platform. 94% of advisors who completed the survey use us as that platform, which is really good to see, and as a preferred platform. We will go through the range of products as these have recently changed over the past year. We'll start off with the SIP proposition, which I mentioned. This is a true SIP. It gets access through to our institutional stockbroking platform. You can access DFMs through there. You can access trustee investment plans. You can go off panel with the investment, and also commercial property. Retirement investment account is our new product, which is aimed at the platform. Our institutional stockbroking platform gets you access through to our DFM, all the third-party DFMs, and the complete range of investments on there as well. ISA, fairly straightforward. We've had that product for some time now. General investment account, and that's across an array of different accounts. It can be an individual account, a joint account, a company account, charity cases, and kind of any type of trust you want to set up there as well. Junior SIPs, lifetime ISAs, junior ISAs, all very niche products on the advisor side, but it's been fantastic for us to be able to offer because we can keep all of the family's investments together, and they can be linked for viewing purposes as well to lead accounts. Offshore bond is one of our newer products which we have launched. We link into Canada Life, Utmost, and Quilter International as well on that. We'll take a quick look at our investments as well. It's an area which we've been operating in for 5 years now, and it's something which has been growing massively within our advisor space. We're an agnostic investment manager, and we just want to give you as many tools as possible to deal with all of your client scenarios. As you can see from the slide here, we link into a lot of the big ATRs which are out there, like Dynamic Planner, eValue, Phonometrica, Synaptics, De Facto, Oxford Risk as well. And you can see an array of our investment solutions just below that. We'll go through the MPS ranges. So we have a passive, an active, and pactive, which is a blended range. We also now have the responsible MPS range. Similarly to the platform, we have a commitment to cost on the investment solutions. And that's from a charging perspective. Whatever solution you choose with ourselves, we will charge 15 basis points. So a really competitive priced investment solution. Performance, we have also been first or second quartile when looking from a 3-year above perspective, which is really pleasing. We'll have a look at ease of use. When looking at the platform, so you can submit business with us online for SIP, ISA, GIA, any standard individual cases. That can also link through to the Origo option system as well. So if the transfer is from a seeding scheme and they're on Origo, the system's intuitive enough to consider whether that can go through and we can link in directly to them. If not, it will generate any paperwork you need. If it does, the system will tell you and it will send the transfer directly through. We do still need scanned copies of forms for some of the more complex cases, mainly trust cases, which require multiple signatures, designated cases as well, again, which may require multiple signatures. Scanned transfer forms are acceptable where the seeding scheme will accept them, same with electronic signatures as well. You can now visibly see all of your advisor charging, which has been set up online. You can request one-off payments as well. And that's the same for income payments as well for pensions. Electronic payments into any of our products can be set up on the system. You'll get a unique bank details and reference number, which you can pay that across to. And there's a detail of some of the forms which we're now accepting on a scanned and electronically signed basis as well. Finally, we'll finish off on some of our developments. New developments, third-party MPS has been an area which has been drastically growing over the past year, 18 months since we added that. You can see a list on the right-hand side of some of the providers which are added, and that'll be a constant list of development as well, as and where we see demand from our advisor space. Multiple ISA accounts. We've had the multiple accounts on the pension. You can set up separate designations on the GIA. We now have that on the ISA product as they're a growing product in size. So you can run multiple investment strategies on there, just making it easier for yourself. The links to the Quilter offshore bond, which I mentioned before, that's a relatively new link which has come into place. Acceptance of digital signatures on all of our paperwork, including paperwork which is going to a third party, but you would just need to make sure that they can accept that as well. The responsible fund and MPS range have been mentioned. You saw them on the slide a little bit earlier, and they're linked. We screen those with the MSCI SRI index to ensure a lot of the worst companies that are out there are taken out of that. Email notification process, which has come into place for pension clients who don't have sufficient income, sufficient cash to meet their income requirements as well. That's recently been added. In terms of new developments, performance report is joining the performance reporting tool on the version 2 of the website. So it's a complete package now. You can select which reports you want in there, making it nice and easy rather than having to do it on an individual basis. Flexible ISA, something we're working on, hoping to have out before the end of this tax year. Bulk reporting, looking at multiple clients and linking them together is something which we're looking at as well. Client onboarding process, making the illustration tool, linking through to the application a bit easier, fund-specific illustrations, being able to link specific portfolios to the illustration as well, which is something we're looking at. Secure messaging dashboard, so that's on the website, everything comes through to there as we move to a more paperless society, and pay slips going online as well for income payments which have been paid out. We're also looking at pushing out email notifications for clients which don't have sufficient cash for ISA GIA withdrawals as well. Finally, I mentioned an acquisition which we made earlier this year at the start. It's a small technology platform which we have acquired. It's actually headed up by the directors who set up Parmenion and a lot of their key dev guys. We've rebranded this product AJ Bell Touch. And what we're looking at bridging the gap between advisors and clients. It's a mobile proposition which is encrypted between phones, and we're trying to get the advice process so it goes directly between phones. You can set up accounts, it will ping to the client, they can open it up from their end as well. And it's just enabling advisors to have an entirely digital service between them and clients, bridging the gap. So with a lot of robo advice coming into markets with big platforms, giving advisors the capability to be able to do something similar as well. And thank you for sitting with me through that platform market update. Our next speaker this morning is Investment Director Russ Mould. Russ will take a look at what has been happening in the markets and provide his insight into the recent performance. He will also address the potential outlook for economies and portfolios for the remainder of 2021 and beyond. Russ, over to you.
Hello, I'm Russ Mould, AJ Bell's Investment Director, and thanks for joining me for the next 20 or 25 minutes, where I'll be just going through a bit of a whirlwind tour of financial markets. What are the key themes? And more importantly, what are the key themes that may help you and your clients in their asset allocation discussions on a strategic basis going forwards? Now, I've called the presentation, well, I wouldn't start from here if I was you, which is a bit of a homage to that old joke. You're driving around a field in Ireland and you're completely lost, and you turn up and you find a farmer who's there leaning against a wall, and you say, "I'm sorry, sir, can you please help me? I'm looking to get to Dublin and I'm lost." And the farmer leans over the field and says, "Well, I wouldn't start from here if I was you." Now, I've been very careful here not to choose a stereotypical joke Irish farmer picture. My children have warned me against that, telling me I've got to behave myself now. So I picked a very serious picture. This is actually John Hurt, Richard Harris and Sean Bean from a film called The Field, set in Ireland. It's an epic family tragedy, so no jokes in that whatsoever, but hopefully it's a more respectful picture of Irish farmers, to go back to that joke. But why have I referred to that rather staid old joke? Well, I think it's because this is where central banks have gotten to. Well, I wouldn't start from here if I was you. They've painted themselves into a corner. They're looking at the possible threat of inflation, and they're starting to perhaps gently back away from their own narrative that the price spikes that we've seen are transitory. And so if that is the case, then maybe they have to start raising interest rates. But if they do so, well, Mr. Sunak, the Chancellor of the Exchequer, has already said every 1 percentage point on his interest rate is £25 billion of extra interest, which, given that he's just had the devil's job getting a £12 billion increase in the social care levy through, will be a bit of a blow to his financial planning. And in the US, well, with the US national deficit at $28 trillion and rising quickly, every percentage point on their interest bill, well, that's $280 billion, a potentially big break on two major economies. So it could be a bit of a Hobson's choice here. Do they let inflation run fast, which we know is a tax on your client's wealth? It erodes the purchasing power of the money in their pockets. Or do they raise interest rates and slow the economy down that way instead? So it is a bit of a difficult choice, and no, they probably wouldn't. Central banks wouldn't want to start from here if they were. And what does that mean for financial markets? Well, they're starting off at a potentially interesting point as well, because we've got record levels of global debt, 50% higher than at the end of the global financial crisis. So again, we're much more sensitive to even minor rate hikes than we would have been previously. We've got central bank balance sheet asset levels at a record high because of quantitative easing. We've got equity indices at or near record highs. We've got bond prices at or near record highs and bond yields at or near record lows, or at least we did until about a month ago. And so in that respect, we're potentially at quite a delicate point of the economic and market cycle. We're looking perhaps at tighter monetary policy. China is perhaps trying to rein in some of the things that Western central banks are wrestling with. Speculative bubbles and things like property, for example, and that's why it seems that Evergrande is going to be a bit of a sacrificial lamb, even if no doubt there'll be bailouts for the people who actually bought the apartments. It looks as if shareholders and possibly even onshore bond holders are going to take a bit of a bath there. Economic data is looking a bit more mixed as we're trying to wrestle with these issues of bottlenecks and scarcities. And again, you've got that nagging issue of inflation. Now, equally, we could have raised multiple concerns on issues such as valuation or inflation or geopolitical tensions over the last 1, 3, 5, 10 years. And any bear doing so would have been completely run over. So why is this any more relevant now than it had been then? Well, first of all, let's just have a look at how loose monetary policy has been as central banks contemplate the prospect of running it less loose or even tightening it. The graphic you can see on the left is the aggregate central bank balance sheets in Switzerland, the UK, the European Union, Japan, and America. And as you can see, their aggregate balance sheets have pretty much quintupled since the great financial crisis, and not far off doubled in the last 5 years or so. And on the right-hand side, we can see interest rates, well, pretty much at rock bottom levels. And as you can see, they have in the past tried to taper or stop adding to quantitative easing. The Fed began to do so in 2018-19, the result that in late 2019, the interbank repo market seized up, the S&P 500 dropped by a fifth pretty quickly. It tried it in 2013, when we got the taper tantrum, bond markets followed the bed and took equities with them. And then they pretty quickly backed off. And again, you can see here, even in late 2020, the Fed was, late 2019, the Fed had even switched on the printers before the pandemic started. The right-hand side, we can see interest rates. There have been well-intentioned, earnest attempts to tighten monetary policy. The lines do occasionally go up. Jean-Claude Trichet got buckets of abuse for it when he tried it at the European Central Bank. Janet Yellen didn't get too far with it at the Federal Reserve, and Jay Powell backtracked pretty quickly. And again, I think that's because we're just so much more sensitive to higher borrowing costs because we have more debt in the system. And it's because also central banks have seemed incredibly aware of any financial market dislocations. And my suspicion is if that we did get any trouble with either, they would quickly recant on rates or QE or both. But at the moment, at least they're trying to make an effort to stop adding to QE and tighten rate. Though again, stopping adding to QE is not the same as sterilizing it. Do you really think that chart on the left is going to go from the peak back to where it came from? No, neither do I. But what's been interesting about the pandemic is not only have we had huge amounts of monetary stimulus, this time we've had huge amounts of fiscal stimulus. This is just a cheats proxy for it, looking at money supply. But what's intriguing this time is that whereas with QE, the central banks use a more almost an indirect mechanism, drive the cost of credit and debt down, get banks to lend. This time we've got central banks and governments almost effectively mailing checks to people and indeed to corporations through bailouts. That money's gone into the system so much more quickly, and maybe that's one of the reasons why we are seeing bottlenecks, because there's an offload of demand out there. People have been mailed stimmy checks, and not too surprisingly, they've been understandably keen to spend them. So where's that left us in terms of financial markets, looking at this very complicated economic picture of huge amounts of stimulus to boost demand, yet potentially some supply side destruction as firms have struggled during the pandemic and lockdowns? Well, these charts here show 5-year performance with the red line, 12-month performance with the grey bars, and not too surprisingly, over the last 5 years, well, it won't shock you that equities have been the place to be as far as your clients are concerned. Equities first, the rest nowhere, because of the old TINA concept. There is no alternative. Cash has not been offering a yield. Bonds haven't been offering much of one either. And therefore, as your clients have sought a yield and capital protection or capital appreciation, they've gravitated towards equities. Maybe they found themselves being pushed further up the risk curve than they would have liked normally, but they've been looking for a return from somewhere, and all of that money's flooded into equities. However, over the last 12 months, commodities have taken the lead, and that's a bit of a change in the mood music. Maybe that's the first sense that markets can think that inflation's on its way, because commodities, real stuff, or paper claims on real stuff through shares, generally seen as a haven during times of commodities. That's based on history. Now, history is no guarantee for the future, as we know, and as Buffett says, if it were true, then librarians would be the best and indeed the richest investors. But nevertheless, it is something that some market participants are clearly leaning on, because commodities have started to take charge. Now, we can also see this on a performance basis, looking at global equities by country. America, straightforward, America first, the rest nowhere for the last 5 years. But again, that's begun to change in the last 12 months. Eastern Europe actually the leader here. Now, from your client's perspective, that probably means Russia. And then from your client's perspective, that means US sanctions, it means corporate governance issues, and that's possibly a bit of a no-no. But very crudely, you multiply the price of oil by 20, and you get where the Russian stock market index is. But if you don't want to get too heavily involved in Eastern Europe, which I could thoroughly understand, there is another market that has underperformed, is potentially cheap, has got a cheap currency, and is starting to perform better. And it's the UK, because the FTSE 100 is crammed with oils and miners who were forecast to contribute something like a third of its profits and a third of its dividends this year. And so if you are looking for a potentially inflationary, or dare I say stagflationary haven, the UK might be the one. And don't forget, we've got private equity crawling over UK companies right now, thinking that there's some value to be had. And that's maybe a message that we should perhaps pay attention to. Now, by sector, equity-wise, again, a similar message to what we've discussed already. Tech first, the rest nowhere. The US is packed with these tech stocks, biotech stocks. That's one of the reasons why it's done well. And why have they done well? Well, because they're perceived to be sources of reliable growth at a time when growth has been hard to find, as we've been stuck in this post-financial crisis, low rates, low inflation, low growth mush. But again, over the last year, the mood music's begun to change. You're starting to see energy and financials take the lead. Two widely disliked, unloved, potentially therefore undervalued value sectors that need an economic headwind behind them to really start to perform. Maybe they're getting one, and that's why they're now taking charge. Again, a classic example, perhaps looking back a year ago, of the old market adage, you can have good news and cheap stocks, you just can't have both at the same time. So there was lots of bad news around in those sectors, but therefore they were potentially cheap if things turned around. What's not doing so well right now are the bond proxies and some of the staples, consumer staples, telecoms and utilities, although utilities do have some element of index linkage in there. And again, they've just started to come into their own in the past quarter, which isn't necessarily showing in this 12-month performance data. And then bonds, well, they've not done you much good at all, really, over the last 5 years or over the last 1 year. Yields got down to record levels, low levels, but prices got to record high levels. And as we all know, because of how duration works, therefore, it doesn't take much of a fall in a bond price to wipe out all of the yield that you've accrued, given that yields have been so skinny. And looking at these bars here, the worst hit areas have been the long duration paper, the 20-year, 30-year paper. And again, that fits in with maybe the US's loss of momentum and technology's loss of momentum, because they're long duration assets, heavily back-end loaded cash flows, future profits seem to be very strong. And again, that's the case with a long-dated bond. So maybe, again, this move, this change in perception from we're moving from a low growth, low rate, low inflation world to a higher nominal growth, higher inflation, possibly higher rate world, is seeing a move from jam tomorrow stocks to jam today stocks, from growth stocks to value stocks, and that's been reflected in cyclical stocks, and that's been reflected in broader themes between markets, asset classes, and individual sectors. So looking at where we are in terms of those performance trends, looking at where we are in terms of valuation, and looking at another part of my job for AJ Bell, which is dealing with incoming media inquiries, what are people interested in right now? And I say that because Sir John Templeton, a man who died a billionaire, so therefore knew what he was doing, always used to say this: people are always asking me where the outlook's good, but it's the wrong question. The right question is, where's the outlook miserable? And I refer again to energy and financials a year ago as a classic case of that. You can have good news, cheap assets, but not always both at the same time. So right now, what's out in the cold and therefore could be value. Now, there may be a reason they're out in the cold. Even I don't read newspapers on get my news from dead trees anymore. I read newspapers on my iPad. You could argue that there are certain industries that are structurally troubled, but there are some that you think actually, they may still have scope for surprising. And if you look at this graphic here, the ones that are out in the cold, commercial property, perhaps understandable because nobody's sat in it right now, but that doesn't mean that's going to be the case forever. Oil and fossil fuel producers, still very few questions coming in, still very little interest, still lots of fund managers, either for reasons of philosophy or virtue or greenwashing or chest beating, or maybe they just think it's good economics and good investment. They're saying they're not going to fund fossil fuel companies. The UK government this week, or just recently in October, has said it's not going to permit Shell to develop the Jackdaw gas field. And you've got lots of pressure from fund managers on oil companies not to invest and continue to return cash or invest in green technologies. So it's intriguing that at a time when we are seeing rising demand for energy, we are intentionally restraining the world's key global source right now, which is gas and oil. Now, I understand why it's happening from a green and a long-term perspective, but it could mean you get a bit of, it could be an explanation for why we're seeing the squeeze right now in the short term. And despite that squeeze, oil stocks still unpopular. Emerging market equities are in the doldrums. Asia's at a 1-year low. China's a huge chunk of that index. And that it's crackdowns there again on internet stocks, healthcare stocks, education stocks making a big difference, property stocks making a big difference right now. That might not be the case forever. I suspect that what they're doing is actually quite sensible. And again, there is, it's still the world's second or third biggest economy, but still GDP per capita very low compared to the West. Huge long-term potential there. Could be something that we may need to start having a look at because it's falling out of favor. And when people start telling me something is uninvestable, that's when I start getting really interested. In terms of euphoria, where are all the questions about? Where are the valuations highest? Where's the performance been best? Investment grade and high yield corporate bonds, US equities, growth technologies, cryptocurrencies. Now, I'm not saying they're going to stop performing. I haven't got a crystal ball, but it won't take much for those expectations. If there's any disappointment, then you can start to see some of those share prices come or asset prices come under pressure. Whereas in the top left, it doesn't take much to surprise on the upside. So, and the intriguing thing here is that how these different sections perform could come down to which macroeconomic scenario comes out of all of this pandemic and supply side disruption on one side and stimulus and demand side boosting on the other. And there is still inflation versus deflation versus stagflation. For those of you who've been lucky enough to listen to me present for the last 7 years, you've heard this theme. And I still don't, unfortunately, know the answer to what's the outcome's going to be. And if I did, I promise I'd tell you. But central banks don't know either, because otherwise they wouldn't be running policies that they described as emergency measures 12 years ago, would they? I can make a compelling case for all three of these scenarios, and I'm sure central banks can too, even if they're sticking still to their low inflation transitory narrative. Inflation, the case is clear cut. We've talked about fuel already, how we're intentionally restraining supply at a time when demand is growing as we come out of a recession. We've already looked at money supply, and that's the Austrian school definition of inflation. Money supply. Remember, central banks can't print oil, they can't print gold, they can't print property, but they can print money. And the other possible source of inflation is onshoring. It looks like it's taken, one ship running aground in the Suez Canal to kind of badly clog up the world's global supply chains. Plus, of course, things like COVID in China, trade tensions between the US and China have also helped. And so companies are now thinking of onshoring to increase the reliability of their supply chains. That's fine, but it might mean you're going to start employing people in Burnley rather than Bangladesh, or Boston rather than Bangladesh, and they're going to be more expensive and good for them too. But it means that firms' wage bills are going to go up. It means that they've got margins to protect, and therefore it means that they may start to pass on the cost, inflation. I can make a case for deflation. Debt we mentioned under the stagflation column, but that is inherently deflationary because the interest bills have to be paid, and that is cash out that could have gone investing on something more productive. Tech is inherently disinflationary. Moore's law says we get a doubling of microprocessor power and capacity every 18 months for the same price. And the intriguing one perhaps here is the demise of the unions. When I was reading my Asterix books by candlelight as a kid in the 1970s during the 3-day week, there was a fuel shock and energy prices through the roof. But also the unions were monumentally powerful then. Ted Heath actually ran an election campaign in 1974 saying, who runs the country, me, the Prime Minister, or the unions? And he lost the vote. Now, the unions don't seem as powerful right now. Just 11% of US labour is unionised, for example. But I'm sitting here in Brighton right now as I record this, and the rubbish truck drivers and the bin men are on strike for better terms and conditions. You're seeing a strike in Hollywood workers at the moment. So maybe, just maybe, labour is starting to demand a bigger share of the pie after the last 40 years when capital has come out on top of labour. This might be the biggest swing factor of all. If you look at a traditional inflationary cycle, you go from commodity prices going up, we've got that. Factory gate prices going up, we've got that. Consumer prices going up, we've got that, as firms try to defend their margins and pass on those input cost rises. The last leg is wage increases. Because if people start to get them, and they will hopefully, as the labour markets are tight, they will want them to compensate for the fact that they're having to pay more. And if they get them, then they can pay more and feel more relaxed about paying more and become accustomed to paying more. Inflation is in many ways a psychological phenomenon. And if people are becoming accustomed to paying higher prices and can do so, that's when the inflationary cycle becomes entrenched. So this demise of the unions and Labour's role in this equation could be absolutely critical. And then stagflation, well, I've talked about debt. This is the worst of all worlds, little or no growth and rapid price increases, just like we had in the 70s. Debt is a key factor there. Zombie firms could be. Quantitative easing's done a great job, you could argue, of keeping the plate spinning since 2009. But there's a lot of firms out there that are just kind of clinging on with, and if it weren't for record low borrowing costs, they wouldn't be clinging on at all. Are these firms clinging on to capital that could be more productively allocated elsewhere? Are we keeping Cartwrights alive when we should be giving the money to Henry Ford? Are we therefore keeping the combustion engine alive when we should be giving, more of a boost to the EV and hybrid economy? It's perfectly possible, and that might contribute to low growth at a time when prices are going up. That's the doomsday scenario of stagflation. Now, to start on the right-hand side, we've had precedents for all of these. Thankfully, stagflation is very rare. And all we've really got to go on is what performed well financially that time around. And again, there are no guarantees for the future. But under stagflation, gold was a haven. It did protect clients' wealth. Now, it started that period at $35 an ounce, not $17.50. So again, we've got to be aware of the starting point here. But gold worked, pricing power stocks worked, because again, they could pass on the costs and protect their margins. Under deflation, that's almost a repeat of what we've had for the last 10 years, at least disinflation. Paper assets, long duration assets, growth stocks, bonds, and cash would be fine, thank you very much. Under inflation, if history is any guide, then real assets or paper claims on real assets like commodities and property, index linkers. And again, not so much jam tomorrow with these long-term growth stocks that have done well under disinflation, but short duration value stocks, growth today, cyclical stocks, you'd expect to do better because nominal growth will look good, nominal profits will look good, and they're coming out after a period of underperformance at much lower prices and valuations relative to jam tomorrow stocks that have done very well and are coming out at much higher valuations. So I'm not saying that equity markets are going to collapse in the case of, say, an inflationary shock, but it would be logical to expect a big shift in market leadership, one for which I would beg to suggest not terribly many fund managers are currently positioned for. So how do we know which one of these outcomes is prevailing? Well, we don't, but we do know which way the market's voting. It's still with the central banks on the temporary narrative as far as these price spikes are concerned. We've looked at that, how things have performed over the last 5 or 10 years. We can look at it here, looking at the Bloomberg Commodity Index divided by the FTSE All World Equity Index. Line goes up, commodities are outperforming. Line goes down, equities are outperforming. It's been one-way traffic for the last 10 years. And although commodities have started to put a bit of a wiggle on relatively, they've barely eaten into 10 years of underperformance. So again, I'm not saying that everything's going to collapse if we get inflation or stagflation and the world begins to change, but you may well get different assets, different equity sectors, and different countries leading the way as a result. So how can we tell what might prevail? Well, these are 5 cheeky little tests. The first one is interest rates. I only did this chart a week ago, and the total rate hikes is now up to 65, 66, according to cbrates.com. After the Reserve Bank of New Zealand, Poland's first rate rises for several years, and Iceland coming in with a second one. So now you've got developed market banks getting involved, not just emerging market ones. The Reserve Bank of New Zealand mentioned inflation, but also mentioned house price bubbles. Again, echoing back there to China. So maybe central banks are having to take some of these financial market asset price issues seriously as well. And if central banks start to raise rates in greater numbers, well, that obviously means they're backing away from their transitory narrative, and inflation is becoming a more serious issue for them. Second indicator, Dr. Copper, great guide to global economic health, using everything from fridges to kettles to toasters to cars to buildings. It's doubled in the last year. That looks pretty good to me. However, we do note there that the prices come off the top very slightly. My guess is this is because of the Evergrande situation in China and the crackdown on property speculation, big source of demand for copper. You've seen the iron ore price weaken as well. So we do need to keep an eye on this, but at the moment, Dr. Copper suggests that all is well. Transports also suggest that all is relatively well. They've doubled in the last year, looking at the Dow Jones Transportation Index. Why is this important? Well, if the industrials aren't doing well, then the transports aren't doing well. And if the transports are doing well, the industrials probably are. Why? Goods have to be shipped. if they're being sold, they're being shipped, and inventory is being replenished and shelves refilled, and they've all got to be flown, driven, sailed, shipped, whatever. So it's good to see the transport's doing well. Again, this index has just come off the top. Don't think that's a demand problem, but we must definitely keep an eye on that possibility. It could be an inflation problem. You look at the last FedEx report, for example, we haven't got enough drivers, our fuel costs have gone up, we haven't got enough pilots. Could be the inflation narrative there, so let's keep an eye on that. Small caps, again, very plugged into their local economies, very much an indication of risk market appetite as well. Interesting, therefore, that US small caps have done nothing all year long. UK small caps have. Again, you'd like to see them really kicking on to, from an economic perspective. Maybe the fact that they're not kicking on is, again, this inflation issue. If you're a small cap stock, you're probably much more at risk of being unable to pass on your input costs. Let's just say you're a loo roll maker in Blackburn, and then you've got to go to Tesco and say, actually, my price has just gone up by 15%. Can I stick you with a price increase of 15%? I'm pretty sure I know what Tesco's will say. It'll be a fairly Anglo-Saxon reply and a very short one at that. So that could be something, again, that we need to keep an eye on from a small cap perspective. And this is just more looking at financial markets in isolation. Stock markets, when they work well, provide appropriately priced risk capital to firms so they can grow and invest, and that's fantastic. What you don't want to see are loads and loads of copycat IPOs and dross coming to market as quickly as possible, just so that somebody can make a fast buck somewhere. So I think it was actually quite encouraging to see that grey line cool off a little bit. That's the US IPOs, or initial public offerings index. The red line cooling off is the global IPOs index. Again, that's probably actually healthy. The black line, special purpose acquisition companies, cash shells that come to market, take money from investors and say, right, we're going to go out and spend it, but we don't know on what yet. Now, that's often a market top sort of sign from all the way from the 1690s onwards. So really, it's quite nice to see these cool off. And certainly some of the anecdotal evidence that we're getting from fund managers right now is a lot of the stuff that's trying to go public in the UK is dross. So I think we'll be looking for market to self-police there, stop that dross coming to market, maintain quality standards, because if loads of rubbish comes out, that's when capital getting misallocated, that's when losses can occur, that's when confidence can drop, and that's when trouble can begin. It's good to see, if anything, these things just cooling, although note again that the US IPO line started to bubble up. So what does this leave us? Well, it leaves us with Voltaire. Doubt is not a pleasant condition, but certainty is absurd. Again, if I knew which of those key outcomes is going to happen, inflation, stagflation, or deflation, I promise I'd tell you. I don't know, central banks don't know, but I do know, we can all tell what the market's thinking, which is we're going to get a repeat of the last 10 years. Low growth, low rates, low inflation, or disinflation, and that swallows the central bank narrative and also assumes that central banks will have our back, that they will be able to manage this, that they will be able to perhaps gently tighten policy without unseating financial markets, without unseating the economy. They might be able to, and fair play, in which case what's worked for the last 10 years will work for the next 10 years possibly. But we have to consider that there are other scenarios, there are other options, and that other things that could happen, which could mean at least a change in market leadership, if not necessarily a wider market wobble. And again, if you just think back to if you decided to sort of extrapolate from our most recent experiences on previous occasions, well, then in 1990, you'd been buying Japan after 10 years of epic performance. In 2000, you'd be buying tech after 10 years of epic performance. And in 2010, you'd be buying miners in China after 10 years of epic performance. On each occasion, you'd have blundered into a period of underperformance on a big scale very, very quickly. If you bought tech in 2000, it took the NASDAQ composite 15 years for you just to get your money back in nominal terms. So I think we must be wary of over extrapolating and be aware of the fact that there are alternative scenarios. Now, the hard part, as we've seen, is that each scenario, if history is any guide, and I stress if history is any guide, requires a different portfolio solution. So therefore, I'm afraid to say the old balanced portfolio is still the way to go, but I wouldn't underestimate the potential for commodities to act as a useful diversifier in the current environment, but nor would I underestimate cash. Not a thing I know a financial advisor wants to hear, not another thing a client wants to hear, but it does provide optionality, because if we do get upset along the lines of the 2013 taper tantrum, the 2018-19 taper tantrum, cash will provide optionality because it'll give us potentially a chance to have a look and buy on dips. But whatever else is going to be the case, it's not going to be boring finding out. I look forward to staying in touch, and thank you for your time.
Thank you, Russ. Any questions you may have for Russ, pop these into the chat box or make a note on your feedback form at the end of the session, and Russ will get back to you. Our final speaker of the morning is another one of our talented homegrown stars, Lisa Webster. Lisa is our resident techie when we're out on our spring and autumn roadshows, and her packed presentations never fail to provide the goods. Providing a review on the government's latest proposals and what these mean for both you and your clients, I'm pleased to welcome, next to your screens, Senior Technical Consultant, Lisa Webster.
Hello and welcome to my technical roundup. So on the agenda today then, I'm going to start by looking at the tax triple whammy, see what the latest tax news is. It's then going to be crystal ball time, looking ahead to the budget that we've got coming up and what may or may not be in there. We're going to have a look at what the latest news is from the FCA, what their focus is, you know, the main areas they're looking at, which will have an impact for advisors. And then I'm going to finish off with two bits of draft legislation or new legislation that's coming out sort of very imminently, that's going to have an impact on pensions. First of all, the normal minimum pension age, and then the statutory right to transfer. So starting off with the tax triple whammy, as I've called it. Now, when we did these road shows in person, we started off touring the country. I started my trip by getting on a tram in South Manchester, where I live, getting up to into Piccadilly, to then go off up to Scotland, where we started the tour. And when I got on that tram, as I got into the city centre, I've been daydreaming a little bit, as you do. It was a Sunday, I was looking around, and then I noticed there was this massive, massive police presence. And it was the day that the Tory party conference started. And so hence why the police were everywhere. If you know Manchester at all, it was the tram goes right outside where they were holding the conference. But it got me thinking that, you know, last time that they were all together would have been 2 years ago, when they actually had the party conference in person, and all the promises and all the things that were being said at that time, which of course was in the lead up to the election, and everybody was talking, you know, it was Brexit was the big news, which to a certain extent it is still, but obviously we've had a lot happen in between times and the world has changed a lot. But the big headlines, really, a lot of the headlines as well, the promises that were in the manifesto that the Conservatives obviously got in with and won the election, was all about the fact that they were going to increase taxes. But obviously things have changed. So, you know, why have they broken, you know, probably one of their big manifesto promises? Well, they've billed this really as this record investment to reform the NHS and social care. Clearly the NHS has been under a lot of pressure for a long time, and very much so in the last year and a half. And social care, I mean, social care, to be fair, that was something that they said there was going to be looked at, that has been in their manifesto for a long time. And it's something that's very much sort of overdue, some would say, in terms of investment and review and changes to social care. So they announced on the 7th of September this record £36 billion investment. Now that is over the first 3 years, that the investment, so 12 billion a year. The first year it is going to the NHS basically, and this investment is going to be ring fenced. But after the first year, some of it will be going towards social care as well. And there will be measures in terms of changes to the means testing for social care and the social care cap, the cap on care costs. But it does mean, obviously, to raise those kinds of money for that much needed investment, we have got some headlines that you would not normally associate with a Conservative government. So highest taxes since the war, tax and spend Tories, new era of tax hikes. Yeah, something that, you know, 2 years ago, you know, would have seemed, you know, unheard of, unthinkable really, that you're going to have, that this is what we were going to get with this government. So let's have a look at what they've actually done then. So first of all, we have changes to national insurance, which are going to be coming in from April next year. So up at the top here, we have our current national insurance rates that we pay at the moment. So we have the main and higher rate for employees there, the employer rate, and then the main and higher rate for the self-employed. So for next tax year, for 1 year only, these are going up by 1.25%. So that was the headlines about a 1.25% rise. But actually, if you look, particularly like on the higher rate for an employee, going from 2% to 3.25%, of course, that's not a 1.25% rise. It's basis points going up by 1.25%, but actually that's a 62.5% rise in tax. So it's a pretty significant tax rise. And again, the same for the higher rate for the self-employed. So we have this for 1 year. And then after that, we're going to have our national insurance rates go down back to the current levels that we have now. And then we're going to have this separate levy, the health and social care levy of 1.25%. Applying to employees, employers, and the self-employed. And the thresholds for that will be the same as the NI thresholds. It's called a levy rather than a tax. It's a tax, it's the same thing. I don't know whether they think it sounds better as a levy. Is that more, is it easier to sell? I'm not sure. So they have said these are going to be ring fenced for health and social care. But when we think about ring fencing in terms of NI being ring fenced, then you look at it and you just think that, well, kind of it's ring fenced, but if there's a shortfall, it comes out of general taxation. And if there was a surplus, it would go into the general tax pot. So it's kind of a little bit theoretical, really. I suppose the question is, why have they chosen to use this mechanism to raise the money, to raise this extra £12 billion a year? Well, national insurance, I think, is the starting point where they're doing it now. So that is a lever, that they can pull quite easily because we already have an NI system, which is why we have the changes coming in from April. They haven't got time to get the new tax, the new levy in time, so that's why we have that for 1 year and then the levy later. A reason for NI rather than income tax, NI, well, first of all, it's more closely associated with healthcare anyway, but also, and quite importantly, I think, is the fact that it's not a devolved tax. So for those of you that are north of the border or have clients north of the border, nothing different can happen there. They're going to be exactly the same. There's nothing that Holyrood can do about this one. It will be the same wherever you live in the UK. So that's probably one reason for doing NI rather than income tax changes. And in terms of sort of, okay, so that's why we're doing NI. But then I suppose the question could be, well, why do we have to have a separate levy? Why don't we just leave it as with this change we've got for next year? Why don't we just keep that? Why are we bothering with a new separate tax? And it's important to note that it is slightly different. In terms of the point of when it kicks in, it will be the same at the lower end. So in terms of age and in terms of thresholds for when you start paying it, the levy will be the same as national insurance. But at the top end, you will still continue to pay the levy if you are employed or self-employed beyond state pension age. There's no upper age limit on it. So as long as you're in employment, both you and your employer will pay the levy. And if you're self-employed, you will you have to pay it, say, once you're past state pension age. In terms of, what this means for people in terms of, what it's going to cost them, apparently the median basic rate taxpayer in the UK earns £24,100. So that will mean an extra £180 a year in either the NI increase for 1 year or after that the levy. For the median higher rate taxpayer, they earn £67,100 and they would pay an additional £715 per year. It's important to remember, of course, for employees, that's only half the story, because yes, that's what they individually, personally will pay extra, but of course their employer will also pay that amount extra as well. So effectively you could double that in terms of the additional cost of employment or per person, how much they're going to be paid, how much it's going to raise on that. At the same time as the health and social care levy, we also had the announcement on the dividend tax increases. So again, this is coming in from next year, the same as the NI increase. and the same thing again, a 1.25% increase, and that is on each of the rates of dividend tax. So if you're a basic rate taxpayer, your rate goes from 7.5 to 8.75, higher rate 32.5 to 33.75, and additional rate taxpayers from 38.1 to 39.35. So if you're a company director and you're taking income by way of dividends, then you are not exempt from this. You will also have an increase in the tax that you pay. But of course, you do only pay it once, whereas if you are paying yourself a salary and you're employed, then you would pay both as the employer and as the employee. So still, relatively speaking, the dividend tax increase isn't as hard a hit, but it does mean they are contributing something to it. So that's the second tax. So we've got the first one, which was, say, the NI increase, which is then replaced effectively by the health and social care levy. The second one is the dividend tax increase. But we mustn't forget, back in March, we had announcements on corporation tax increases as well. So these don't come in until April 23, so a year later. But by the time we get to 23-24 onwards, you are effectively having a triple tax whammy. You're having all three of those increases. So our main rate of corporation tax is going to be going up to 25% for companies with profits of more than $250,000. There will be still this small profits rate for companies that profits remain below 50,000, and that will still be at 19% as we have now. And then there will be a tapering system in between the two. But if you've got a company, profits of more than £250,000, obviously employing people, if the cost of employing those people is going to go up because of the health and social care levy that they will have to pay. So that's going to have a dent in their profits for the year. Their profits, what profits they have still, they're going to pay a higher rate of corporation tax. And then once they've paid their corporation tax and they're paying out dividends out of those profits, those people who receive those dividends are also going to be paying a higher rate of tax as well. So this is why we end up with this triple tax whammy, that we can have that money taxed 3 times. So what does this all mean? Well, it does mean that when it comes to salary sacrifice for pensions, it really does supercharge it, because it makes it even more attractive. It's always been an attractive option from a tax point of view to use salary sacrifice pension contributions, but it's just got even more so, because with salary sacrifice you can avoid the new health and social care levy, or if you're talking about next year, those NI increases, both for the employer and the employee. Obviously, if you're paying pension contributions, then you are reducing the profits that you pay corporation tax on. So after April 2023, that could be 25%, or if you're in the tapering, it might take you down, through the ranks of what you pay on the tapered amount. And then any investments that you have, obviously once within the pension, as a tax wrapper, you don't pay dividend tax within the pension wrapper. So, really makes it even more attractive option to do so. And just generally tax wrappers, obviously ISAs, should mention that as well. You all know for your clients about using the annual allowances, using their ISA allowances and pension allowances as appropriate. But it just becomes even more so, because the difference between using your ISA allowance and not using it, because the taxation position on dividends, because it's going to cost you more outside of an ISA, gives you even more reason to do it. Just emphasising the benefits really on that. So moving on to the budget then, and crystal ball time. I've called this budget round 3, budget 2021 round 3. Because see, we had a budget already in March, where we had those corporation tax rises announced. We also had things like freezing of the capital gains tax allowance, income tax bands freeze, lifetime allowance freeze, all for the next 5 years on that. So we had that announcement already. Feels like a long time ago, but it was only earlier this year. But then on the 7th of September, we had all those announcements that I've just talked about. We had the NI increase and brand new tax, health and social care levy, dividend tax increases. We also had the announcement on state pensions that we're not going to have the triple lock next year. We're going to have just a double lock instead. So that really felt like a budget to me. You know, all those announcements are things that would normally come in a budget. So it kind of feels like when we get to the next one coming up very soon, that it's round 3 for the year. It feels like we'll be on our 3rd budget of the year. So, you know, the question is really what's left. They've done so much already in this year's budget announcements. What do we think they're going to do? Now, first of all, I'm going to caveat this by saying I don't know. I don't have insider knowledge. Obviously, there's rumours going around. There's all sorts of things going on. You know, what do we think they could do? What might happen? What might not happen? Obviously, we always have rumours about pensions, changes to pensions tax relief, changes to tax-free cash. It wouldn't be a budget if we didn't have that, I think, in the lead up. Gut feeling really is there's so much else going on at the moment. A massive overhaul, you know, in terms of moving to flat rate relief with pensions. It doesn't feel like the time's right. There'd have to be consultation on that beforehand. They've looked at it before, and I think it's in the too difficult pile, especially when you look at what happens with DB pensions as well. It just gets really complicated. So I think that's unlikely at the moment. We are still awaiting the outcome of the Pensions Tax Relief Administration consultation, which we had, which sort of closed October last year, which we were expecting in the last budget, but, you know, the things took preference over it, and, you know, we didn't hear anything about that. And that's the one where it's looking at the net pay issue and how they resolve that. We're still waiting the outcomes. There could be something on that. I mean, that's something that is overdue, and again was in a manifesto promise that they were going to look into that. But we'll wait and see. You know, tweaking of allowances then. See, well, they've already frozen the lifetime allowance back in March, so you're probably not going to touch that one again, you would think. Annual allowance, possibly a bit more likely that they might do something with the annual allowance. I mean, the other thing as well is I've just been talking about salary sacrifice being supercharged. Obviously, you know, that sounds really good. So there is a question mark. Do you think, well, is it too good to be true? Are they going to cut down on it? Now, usually, if they're going to do any anti-forestalling measures, you would expect that to be announced at the same time, like we had with the tapered annual allowance and the measures that they put in place there. And they've not done that this time. So is it an oversight? Are they still planning to do something? Or does it, because it's not happened, mean it's not going to happen? Who knows on that one? But you know, a wider measure that could still control the amount that people use it would be to cut the annual allowance instead. You know, would you cut it down to 30? Would you make it down to 20,000? Keep it in line with the ISA allowance? Possibly. Still think with that one you could end up with problems with the NHS. You'll all be aware of the issues we had with the tapered annual allowance and doctors and the problems it caused there. You know, do they really want to go there again? You know, a cut down to 20,000 would, I think, at the top end of the consultants start causing issues again. But you know, we'll have to wait and see on that one. Probably more likely on pensions. There was, some of you will have seen the headlines, I'm sure. The Institute for Fiscal Studies have come out and said about how pension death benefits are indefensibly generous, I think was the quote from them. We all know when pension freedoms came along that the death benefit rules were very generous. I think probably took everybody by surprise, really, how generous they were. You know, on death pre-75, that only benefits can be paid on tax-free usually. There's no inheritance tax. So there is, if anything, on pensions, there might be something around that, possibly. Looking at the wider picture with inheritance tax, so there has been a review of inheritance tax by the Office for Tax Simplification at the request of the Chancellor not very long ago, which hasn't had anything acted on it. So could you do something either to change death benefits, taxation of death benefits within pensions, or bring pensions into inheritance tax? These are things that could be looked at. I'm not saying they will, but you know, it's not beyond the realms of possibility. I mean, wealth taxes, I think, are probably an easier target at the moment. And capital gains tax is another one. So the current Chancellor requested the Office of Tax Simplification look at changes, look at capital gains tax, how that's working. They've reported back on that. There is nothing that's been done on that we've seen yet. So obviously we did have a freeze on the allowance back in March, so don't know whether they cut it again. It's not beyond the realms of possibility, but the suggestion in the report would be to align CGT rates with income tax. So obviously that would be an increase in CGT rates from next year. That is something that does seem to be sort of gaining popularity in the rumours that could happen. And then another one with the allowances, your dividend allowance. Obviously, we have the increase in dividend tax. Another way, sort of like two cuts at the dividends would be to reduce. We have a £2,000 allowance at the moment, personal allowance. Would they cut that to £1,000 or even lower, potentially on that? So we'll have to wait and see what gets announced. Moving on next to the FCA then. What they've got going on. So a couple of things just in their business plan that came out earlier in the year on pensions, just to touch on briefly before we go into a few more details and a few other things. One of them is about non-workplace pensions and having default investments. We have investment pathways already for drawdown, which caused a lot of work for us as a provider, for not many people going into it. But I think for you as advisors, probably, it's just something that you have to reference when you give your investment advice for drawdown clients, that why you're choosing whatever investment is more appropriate for your client than that default. They are looking to do something similar for accumulation stage non-workplace pensions, about having a default investments in all personal pensions. They've been talking about this for a long time, and it keeps sort of getting kicked back and put back and put back. It is still in the business plan for this year. They have said they're going to have a consultation out before the end of the year, so it's not gone away completely. That is something we are expecting to see out quite soon. Hopefully, from your point of view, it'll just be a similar, you'll just have to reference whatever the default is, and then obviously explain why what you're doing for your client is more suitable than that default, and shouldn't have as huge an impact for you as maybe it will have for us. Another thing from the FCA, they're sort of focused on the pensions area, is this driving value for money. Now, those of you who are alert will have spotted straight away that this is not on an FCA website. This is on the pensions regulator website. This is good news because we actually have some joined up thinking from both regulators. So this discussion paper is jointly by pensions regulator and the FCA, and they're looking to drive value for money. So they have this paper which is out at the moment for consultation, and they're looking sort of at the definition for value for money, and it's not just being about costs and charges, though obviously that is the first thing that springs to mind, and that is a big part of it. But also, they're looking at concepts like, good customer service can help savers make the right decision at the right time, and that can make a real difference, sort of how much they contribute to their pension and how they engage with their pension, and how they sort of make sure that meets their retirement needs, and about good scheme governance. And where we think they're going with this is that they're kind of going to come out with some kind of sort of metric score. That's not definite, that's just sort of feels like that's sort of where it's going at the moment. So we'll be able to have some ratings on personal pensions for workplace and non-workplace pensions, sorry, not just personal pensions, workplace and non-workplace pensions, have some kind of metrics score for them, how they rate for value for money, to make it easier for people to make comparisons on that. So this paper is open until the 10th of December. So if this is an area you are interested in, if you want to have some feedback as to what should go up to, how we define that value for money, what should be included, what shouldn't, those factors, then now's your chance to have your say on this. And the feedback statement setting up the next steps on this, it will be due out next year once this one's closed. They've had a chance to review it. Another big area of interest for the FCA is on consumer investments. So there was an initial consultation call for input earlier in the year, and then we've just had this strategy and feedback statement. Now, but this is a really big piece of work, so there's going to be lots of different areas there's got to be lots of spin-offs, different consultations and papers and bits of things that come out of this from the FCA, all within this banner of creating the right environment for consumers to invest. And there's different bits and pieces going on here. There's a little bit up at the top here. It says about enabling access to advice or other support for consumers to make the decision to invest. They haven't given an awful lot of detail at this stage, but obviously there's a bit there about enabling access to advice. So that should be an area that's of interest to you all. So we'll see what they come out, how they're going to go about that, sort of what the proposals are in that area. Down here we've got a bit where the concern with the cash deposits and people keeping too much money in cash. So they're wanting to support the development of an environment where consumers can invest confidently. It must be clear to consumers what happens if things go wrong, and the cost of redress must be met in a fair and sustainable way. Now, in this area, they are planning on releasing a discussion paper before the end of this year. And within that, they're going to be looking at how they make advisor firms more sustainable, and looking at sort of changes, possibly increases to capital adequacy for advisor firms, with the idea being that each firm is more sustainable, so that if something goes wrong in one firm, it has less of an impact on other firms. And they are aiming to have year-on-year reductions in the FSCS levy, which I'm sure if they achieve that, that will be something that would be welcomed. They did say when this first came out, they were targeting a 10% year-on-year decrease in the levy, but they have since retracted that, and it wasn't meant to be in the public domain, but it's a bit late now. It's already been there and been in the press. But yeah, so it was meant to be internal. They were denying the thing. It just wasn't meant to be out in the public domain as an internal target. But yeah, so obviously that's, something that's going to have a direct impact. To say discussion paper due out by the end of the year, so do have a look out on that one and have your say on that. Next one we've got here is about mainstream investments, and so the work they're doing here to encourage firms to help consumers identify and access investments that suit their circumstances and attitude to risk. Part of this will have a bigger impact on us as a provider than on you as advisors, but obviously you should be aware of what's going on. There are talks about the FCA doing some sort of guided ISAs, guided investments within ISAs. So it's a bit like talking, default investment pathways we have for drawdown at the moment, and they're talking about bringing into accumulation stage pensions. There's something like that, though early indications are it won't quite work in the same way. So we'll have to wait and see on that one, but there will be something whereby we have a bit more of a framework to guide people into investments within, and it is specifically ISAs. I don't think it's even going to cover lifetime ISAs. It is specifically stocks and shares ISAs on that. There's a consultation on that due out the first quarter of next year, 2022, with a policy statement before the end of the year on that one. Next one they've got on here is about higher risk investments, ensuring consumers only access higher risk investments knowingly. Obviously, the FCA are very concerned that people don't understand the risks when they're going into investments. First one that springs to mind is cryptocurrencies, that people don't really know what they're doing. Other high risk investments are available, but that's one that I think they're particularly concerned about at the moment. And they are launching a consumer campaign this quarter, so before the end of the year we should start to see something on that, some advertising, etc., consumer campaign to help make people aware of those risks. Final one there that they're looking at is scams and fraud, about protecting consumers from scams and to maintain trust and confidence. And as part of that, there is another consultation paper due out again before the end of the year on a new financial promotions regime. So there will be changes coming in that way. Last sort of big area I'm going to talk about from the FCA is about the new consumer duty. So we already have a consumer duty. This is like, the V2 consumer duty, the bigger, better consumer duty a bit more beefed up or something. So this one, we had a consultation out which closed in July, and we were going to have a further consultation with a bit more details on it by the end of the year. So the consumer duty, looking at requiring firms to ask themselves what outcomes consumers should be able to expect from their products and services, act to enable rather than hinder those outcomes, and assess the effectiveness of their actions. So really what the FCA are wanting here is to see firms putting themselves in the customer's shoes, asking, you know, would you be happy to be treated as the way that your firm has treated your customers? You know, would you recommend your firm's products and services to friends and family? This is one that affects us all. You know, it affects us as provider, and it will affect you obviously as advisors for your customers or consumers, as the FCA call them. So I say the consultation due out by the end of the year will set out the consumer principle from the FCA, which will be a clear tone and use language that reflects the overall standards of behaviour that the FCA expect from firms. Underneath that, there will be these cross-cutting rules, which develop and clarify the consumer principles, overarching expectations of firm conduct, set out how it should apply in practice. And then we have the 4 outcomes at the bottom there, which is going to be a suite of rules and guidance that set out more detailed expectations of how firms should be acting in relation, to like communications, products and services, customer service, price and value. So I say those guidance and rules, we should expect to see the draft of those in the consultation before the end of the year. So certainly one that we all need to keep an eye out for. Okay, moving on, we have some new legislation on the way. So first of all, looking at the normal minimum pension age increase. Now, hopefully we should all be aware of this already, that the pension age is going from 55 to 57 with effect from 6th of April 2028. This was announced alongside pension freedoms back in 2014. So it was announced 7 years ago, and we've still got 7 years to go on it. So plenty of notice that this is happening. It's just we've only just say February this year we had the first consultation in terms of how they're going to implement it. Now, I'm not sure what people's views are on the increase from 55 to 57. Personally, I don't have a massive issue with it. I can see the reasons of why they're doing it. And in itself, I don't think having an increase is a massive issue. We've had it, we've had plenty of notice on it. We've had it before when we went from 50 to 55. The issues arise with this is the method, the way in which they're implementing this increase, which is going to cause a few issues, I think, if it goes ahead as proposed. So basically, yeah, from 6th of April 28, normal minimum pension age will be 57. There will be some exceptions to it. First one is for uniform services pension schemes. Don't really have a massive issue with that. It's this second part here which causes problems, and then all the transfer rules and things associated with this. So there will be an exception to the increase where there is an entitlement to benefits at age 55 under the scheme at 5th of April 2023, and where the rules confirmed that right on their members on 11th of February 2021. So to explain that further, the 11th of February 2021 is when the consultation on this first came out. And so what this means is if the scheme rules, as at the 11th of February 2021, gave their members an unqualified right to take benefits at age 55, then they can retain that right. Also, if anybody, as long as it was in the scheme rules at that date, any new members joining the scheme before 5th of April, so they are a member of the scheme at 5th of April 2023, will also have that right. So to have an unqualified right to take benefits at age 55 under the scheme rules have to actually have the number 55 written in it, rather than referring to normal minimum pension age or referring to the legislation. It has to have the number 55 in it. But it's also, there's this bit about the unqualified right. Now, when this came out, we thought it was only likely to be some occupational schemes that had an unqualified right. You know, and that is the case. It's most likely to be in an occupational scheme that you have that unqualified right. I think there is one personal pension provider who believes their scheme has it, but they have removed their scheme rules from their website, so nobody else can look at it to know whether it's, you know, is it just their interpretation that's different to everybody else's, or you know, is it written differently? I don't know. I can't comment on that. But the unqualified right bit, with our scheme rules, and most personal pensions as well will have this, it is when you request to take benefits, it is subject to scheme administrator or trustee approval. So, and that means it is a qualified right because it's subject to their approval. It's not an unqualified right. The reason that most schemes have that in it is as a defence against scammers, basically. So, you know, if we have a member come and ask us to take benefits, and we have reason to believe there's something going on behind the schemes where they're being pressured to take benefits, or, you know, they're wanting to make some investment, which is, you know, maybe they tried to do in the pension scheme and then they can't, and then they want to do it elsewhere, and you know, it's been turned down for very good reason, and it's not just because it doesn't fit within a pension scheme, it's because it looks like there's something, you know, there's a potential risk of scam, etc., etc. You know, it's very, very, very rarely used that, you know, we would refuse somebody's benefits, but it is there for that purpose as a defence against scammers. So the problem with writing this draft legislation as it is that, well, one of the problems we have with it anyway, is that we don't think that this is going to be the last time pension age ever goes up. You know, they said at the time when they made this announcement, the intention was to peg it 10 years below state pension. There's nothing in the proposals at the moment, the draft legislation, that actually says they're doing that, but that was, you know, was the policy intent at the time. And if, you know, this goes ahead now and we think there's going to be future increases, well, schemes that don't have an unqualified right to take the benefits are going to have a commercial disadvantage to a scheme. So there's an incentive for schemes now to rewrite their scheme rules, just give their members an unqualified right to take benefits at, it'll have to be age 57, so that when it goes up again, they can retain that right if they apply the same rules again at the next time they do an increase. And if you don't, you know, if you don't do that and you don't change your scheme rules in that way, and everybody else does, they will all have a commercial advantage over you. So we just think that's good news for scammers, because they, you know, they're going to be rubbing their hands. Everybody's got an unqualified right. They can put pressure on people. They can, you know, do whatever, and people, they can force providers to pay out the benefits to those people, maybe vulnerable people, you know, etc. So we don't like it for that reason. We think that causes problems, and, you know, and there's a lot of other work going on against scams, and it just goes against that. So we're not very comfortable with it on that. Another thing is about, you know, your policy intent. You know, if you're trying to increase this because, you know, maybe slight dip in it, you know, with the pandemic, but that aside, you know, people are living longer generally, and you're trying to increase this, then by having this protection, you know, you could have, because somebody only has to be a member of the scheme by 5th of April 2023. So, you know, somebody can go and join the scheme now. You could have somebody, if you're talking about an occupational scheme, who, you know, somebody who leaves school, starts work at 16, you know, and they join, you know, on the 3rd of April 23 at the 16, they can join a scheme and they'll still have the right to take benefits at age 55. And, you know, with a personal pension, you can have a baby, because you can have a junior pension, you know, that's born start of April 23, and they can still have the right to take benefits at 55, which just seems ridiculous. And like how long these legacy issues could go on for, you know, it could be quite extreme really on that. So those are sort of, you know, issues that we're not particularly happy with. There's also going to be complications with the legacy issues on the transfers. So I'll just have a little look at that. So let's just say you've got a client that has two pensions. One has got protected retirement age of 55, most likely going to be an occupational scheme, and then you've got the second scheme which doesn't have any protection. So I'm sure plenty of you will have clients, you know, say they'll have an occupational scheme, they've got a personal pension. At some point you might want to do a consolidation exercise, you know, before they take benefits, or, you know, whatever it may be, and you've got scheme A, the red one, protected age, scheme B doesn't have it, and you decide, whatever your reasons, you're going to move scheme A into scheme B. If you do that just as a normal transfer, you will end up with something that looks like this. So what this means is the bit that's come across from scheme A, which had that protected age, those benefits are ring fenced in the new scheme. And you can still access those benefits at age 55, but the rest of it, which is the existing scheme or any new other transfers in or any new contributions, you'll be able to access from age 55. So you have two different retirement ages under one scheme. We think that's not simplification. We think that's going to complicate things. It's going to be harder for you to explain to your clients. It's going to be harder in a world where we're going to simpler statements we're meant to be issuing, where we've got different benefits. It's going to be harder when we have things like pensions dashboard. You know, we're meant to be projecting income for people from when they can take the benefits, and it's going to be two different ages within one scheme. We just think it makes things overly complicated. And obviously, you know, if people are transferring and you're making decisions, having different retirement ages, that can be a factor in it. You know, even if your client doesn't have any intention of retiring early, retiring at age 55, you know, it's still got to be part of your report if they're losing the right, or they're going to have this complication going forward. And I just think, you know, this could happen to somebody, you know, who's in their 20s, and you could have this ring fence for years and years to come. So it could go on for quite a long time. We haven't seen any information yet about these sort of, you know, transfer information requirements between providers, how the information gets passed on, you know, when somebody does have a protected age associated with some of the benefits, and how all that's going to work. Right, so go back to the transfer scenarios. So this is if you transfer scheme A to scheme B, just as a normal, what I would call a normal transfer, then you end up with these ring fence benefits. So you don't lose the rights on transfer, but they are ring fenced within the new scheme. But you could do a block transfer, would be an alternative, but slightly different from block transfers. As you know, block transfers, when you've done it in the past for people with protected age, like sports people, or people with protected PCLS, the rules are slightly different. But if you do a block transfer, then the new scheme inherits the protected age effectively, and you can make new contributions into that scheme, and it'll all be age 55. So the block transfer in this context, you just need to have two people transferring from the same seeding scheme to the same receiving scheme. That's it, just two of them at the same time as part of the same transfer. So it doesn't matter if you've been a member of the receiving scheme for more than 12 months, that requirement falls away. You could have been in it for years, that's fine, as long as two people come across at the same time, you will still have the protected age of 55. And importantly, you don't have to crystallise all your benefits at once. Again, that is different to how you would know block transfers normally. So again, it's just more complication, it's different sets of rules. So getting that transfer information right, how providers ring fence it or not, as the case may be, you know, which kind of block transfer is it? Is it one where you have to crystallise, or there's one where you don't have to crystallise? Just think there's just more complication there's more potential for it to go wrong. And it's more difficult for people to understand their pensions and what they can and can't do with it. I just think it just overly complicates things. Just last one in terms of the transfers, if you do it the other way around, so if you move scheme B with no protection into a scheme that does have the protection, as you would expect them, because it's all gone into the scheme that's always been protected, that stays with the protection. So that is, you know, pretty much as you would think it would be. In terms of Andy's views on this, this is an article that he did back in August. What on earth is the government thinking with the pension age hike? I say it's not necessarily the 55 to 57 hike that we have the problem with. The issue with it is because of the way they are doing it with all the complexities. We think either you don't do any protection at all, maybe do your uniform services pension schemes, that's fine. Either just make it 57 for everybody, or if you are going to want to offer some protection, why don't we do it the same as we did from age 50 to 55, like we did a few years ago? Much more straightforward, less people had the protection, so it has a bigger sort of policy impact, like the policy intent was in the first place. But we'll see. We're not the only ones who think like this. The ABI came out, this is in September, about stopping more confusion for pension savers. We have written to anybody and everybody that we think may be interested or listen, Guy Opperman, the FCA, the Treasury, HMRC, giving our views on this, about how we think, you know, it's just too complicated how they're doing it. Since I put these slides together, I've also seen, as some of you will have seen in the press, I'm sure, that the ABI have also written to Stephen Timms, the chairman of the Work and Pension Select Committee, saying as a matter of urgency that the current plan to increase NMPA from 55 to 57 should be paused at least. You know, we've got 7 years till it comes in. You don't have to rush it through. Plans are for this draft legislation, as it's written, to form part of the finance bill, which would come out on the budget. And then obviously it has to go through Parliament, but we just think they don't need to rush it that much. Can we just take a step back and come up with a better solution, a better way of doing it, please? So we'll wait and see if that's listened to at the moment. You know, again, we should find out with the budget whether they're ploughing ahead with it as it is. I say whether it goes into the finance bill or not. Okay, last one I'm going to talk about quickly on this one is the statutory right to transfer, because we have changes again to legislation, secondary legislation, doesn't have to go through a finance bill or anything, which are due out imminently, sort of in the next couple of weeks. When they come out, they will take 3 weeks to have an effect, so this should change, you know, certainly before the end of the year. Changes to the statutory right to transfer your pension. Why are we doing this? Well, it's basically to stop scammers. Some of you will be familiar with this case from a few years ago, Royal London, Donna Hughes case. This was where Donna Hughes was a Royal London client who wanted to transfer out to a scheme that Royal London had concerns about. It was an occupational scheme. Donna Hughes, they refused the transfer because they thought it was a scam. They blocked it. She went to the Ombudsman. They sided with Royal London. It went through the courts. Initially, they sided with Royal London, and then eventually it went to the High Court, and they ruled that no, there was a statutory right to transfer. And the statutory right to transfer arose because under current legislation, if you have a statutory right to transfer to an occupational scheme if you are an employee. But the bit that's missing is the fact you don't have to be an employee of the sponsoring employer. And Donna Hughes was employed somewhere, but not by the company involved. But because the way it's written, the High Court ruled there was nothing that we could do. There's nothing that Royal London could do. The statutory right existed. We had to make the transfer. We don't believe that it was Donna Hughes herself who pushed for this to go through the courts. We think it was somebody behind her to try and get this ruling, and they were successful. We certainly had transfers at the time where we had concerns. Transfers to SAS, which, you know, there's very good reasons for doing SAS. We're not anti-SAS at all, we are a SAS provider, but unfortunately SAS has been a victim of being a vehicle that's been used by scammers in the past, and you know, there's a lot of changes that have gone on now trying to stop that. But we had transfers out where we had concerns about the scheme. And a similar thing where somebody was employed but not by the sponsoring employer, and basically the day this ruling came out, they were on the phone to us telling us we had to transfer out, and they were right, there was nothing we could do about it. So yeah, you know, this was good news for scammers, but the good news for us now is, and everybody else, is that changes have been made so this can't happen again. So what's going to happen, we think, when this comes out is going to look something like this. So you're going to have a green list where there's still a statutory right to transfer to a public service pension, master trust, collective money purchase scheme when they get up and running, and also where the trustee or scheme administrator has no concern. So we will still be able to do our due diligence on schemes. It's not been too prescriptive in terms of the rules of exactly what we have to do. There is the industry guidance, the PSIG group, Pension Scammers Industry Group, guidance which most companies will use. So it may be when these rules come out, there's a bit of extra due diligence that we do on our, what we call really internally, if you like, our green list or our approved ones, and, you know, transfer out to those schemes should be able to go ahead as normal. So you shouldn't see a big impact on the transfers to the vast majority of your scheme transfer requests that you do. There will be some changes. The ones you're probably most likely to see things is if you're doing a transfer to a SAS, because obviously a SAS is an individual scheme each time. They're not going to be on a pre-approved green list from a provider. You know, they're going to be, you know, ones they have to look at a case-by-case basis. To have a statutory right to transfer to an occupational scheme, you will have to evidence the employment link with the sponsoring employer. So that one, you're normally looking at 3 months pay slips as an obvious one with that. And if you get that, then the statutory right to transfer will still be there. You can go ahead. With SAS, it doesn't mean if you don't have the statutory right to transfer that the transfer can't go ahead. It will be at the trustee scheme administrator's discretion. I say it won't be statutory right to transfer, it doesn't mean you can't. Do sometimes get, again with SAS, you might sometimes get a family trust, family SAS, so there'll be a family member whose business is the sponsoring employer, but they might want to invite other family members into the scheme who aren't actually employed. You know, we'd do due diligence on that and have a look at, you know, the scenario, and as long as you're happy with it, then the transfer should still be able to go ahead. You may find you get more questions on it though going forward, so that might slow down a little bit. Overseas information is just if you're transferring to CureOps, you'd want to see evidence of residence of where they live. Trustee scheme administrators can ask a member for more information. We can refer people to Money Helper for scams guidance if there are amber flags, things that we're not certain about, we're not happy with the answers, or we're not getting the information. And we refer them to the Money Helper scams guidance service, and if they go and get that, they will get a reference number which comes back, and we can then check it to prove that it's real, that they've had that guidance, and then the transfer should be able to go ahead. But obviously if they can't evidence it, they've had that guidance, or we don't get the answers, then there is a red stop, so that we will have the power to stop transfers where we have concerns. So this is good news in the defence against scams. I think when this consultation first came out from the DWP, there were concerns as to how they were going to do it, that it could really clog up the transfer market, because it was going to be too prescriptive. You know, there's going to be issues where, like, normal, what have been straightforward transfers could get caught and slowed down. I think from the way the consultation has gone, obviously we've not seen the final detail yet, the impression we get is actually they have listened, hope I'm not proved wrong, and that it shouldn't cause major issues. Most of your transfers should still go through as normal. I say there might be a bit more around occupational schemes that you have with transfers. So amber flags, you know, these are things where members giving complete responses, you know, the evidence, we don't have the evidence we need, etc. One thing I will just mention, sort of a key point on this, is that we think there will be circumstances in the rules where we have to ask the member questions directly, not you as their advisor. I mean, I can understand why they've done it, because, you know, there's always the odd bad apple in the advisor world, as in any world, but there isn't something dodgy going on there that we have to go to the member direct. But if, you know, if the provider goes to your client directly to ask them questions on a transfer, please don't take it personally or take offence at it. You know, you should be aware that they may have to do that because of the regulations. So yeah, it's just one thing you need to be aware of on that. And then obviously, yeah, red flags to say, you know, there's certain points which means we will be able to stop. So that is good news for us, I think, and the defence against scams. So it hopefully should work well. Right, that was the last thing I wanted to talk about today. So I do hope that you have found that useful and of interest. Don't hold me to any budget predictions, please. I'm not sure what's going to happen. We'll all wait and see on that one. But thank you very much for your time.
Thanks, Lisa. Again, any questions for Lisa, please pop them into the chat box and she will come back to you. So that concludes our session for today, and I hope you found the content useful. As soon as we finish here, wait for the screen to change and your feedback form will pop up. It will take less than 2 minutes to complete, and in return, we'll send you your CPD and a copy of the slides via email. Thank you again for your time today and for your continued support. Until we see you again, please take care.